Welcome to the daily update, where I'll go over the action in the market for Friday, May 9th, and we'll see how things look for Monday, May 12th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Kind of a sleepy day that lacked conviction on Friday. There's a lot of pent-up hope because this weekend, China and the US will be conducting trade talks in Switzerland. So there's some real hope that maybe something can be worked out there. And plus, as we've been bouncing up from these lows that we saw about a month ago now, it's been on below average volume. Even when we have down days, it's still below average with volume. You've got a lot of folks that are really confused about what's going on right now and where do we go from here? What's the economy going to do? What about earnings? What's going to happen? Are we going to go into a recession or are we going to stay out of a recession? And all we can do is just see what the charts are telling us right now and take it day by day and then evaluate where we're at right now, realizing that it can change. It could change for the better or it might change for the worse. All right, so right at the open, we had a bit of a higher open. The futures were relatively optimistic, but then right after the open, prices declined down below the daily pivot at 56.73 and then went negative. We fell below the unchanged level. We found support at 56.50. Then we just kind of spent the rest of the day chopping between the daily pivot and 56.50. And we ended up closing slightly negative. So not an awful lot of conviction there. We were virtually unchanged, but it goes in the books as a down day because we were down 0.07% on well below average volume. We've been below average day after day. This was even below that. So we are still positive, though, in the short and intermediate term because we're above the 20-period moving average in the short term and the 50-period moving average in the intermediate term. We're still negative in the long term because we're in a downtrend there. Interest rates, helping out a little bit. We'll get a read on inflation in the upcoming week. We're going to get CPI and PPI. And the way I see it is the employment report is usually the most important economic report of the month. CPI is number two. And then we're going to get retail sales and PPI, and those kind of all feed into the inflation picture. This past month, past couple of weeks, the GDP was important because we get other GDP reports, but those are just updates of what we've already seen. And so that one is also pretty impactful, but we only get that once a quarter for the first time, the number that we've never seen before. And everything is about the trade talks this weekend. If they can come to some kind of a deal, if the market will be happy with what's going to come out as far as the tariffs, what that might do to the economy. And in the meantime, we are not trending either in the short or intermediate term. And I'll show you the charts to go with this. The ADX is actually below 20, both in the short and intermediate term. So if you implement sideways strategies, and we could break out of that. When we go into these trendless environments, we don't know how long it's going to last. But there's some things kind of coming together that maybe this will last just a short period of time, or maybe we're going to see this for an extended period of time as the market tries to figure out what's going on. Okay, so some comments. There was a real lack of conviction because of the trade meeting between the US and China in Switzerland. There is hope that there'll be some kind of de-escalation that is agreed upon when it comes to the tariffs. So it would be a profound disappointment if there was no change to these meetings. It's like, well, we just agreed to meet again. Well, that is not what the market is anticipating. They're anticipating some kind of change, and then it'll have a chance on Monday to react. Usually what I start doing is Sunday evening. That's when the futures open. And I go to investing.com. You can watch the futures. They trade 24 hours a day, 6 days a week. They close on Friday and then open again Sunday evening. So feel free to check that out if you don't already do that. Currently, we have the 145% tariffs by the US and 125% tariffs by China. Can this get taken down? We'll see. But the Trump administration is considering a tariff of 60% or less to get things going. Yet then on Truth Social, Trump came out and said 80% tariff on China seems right. It's up to Scott B. Well, Scott B is Scott Bessent, and he's the Treasury Secretary. And so him, along with the trade representative Jameson Greer, they're going to discuss things with the vice premier, and I can't even begin to pronounce that name, even though I have Chinese students that I teach English to. Doesn't mean I know how to speak any Chinese. So they're meeting with a high level person from China as well in neutral Switzerland. We are dropping with the VIX, but we're still above 20. We're coming in at 21.9 right now, but still above 20. The usual suspects, we've been pretty positive lately. So we see our short-term indicators, the StochRSI, Williams percent, are none of the CCI, the commodity channel index. Those are not on the list right now. The stochastics are still extreme positive. We're still far away from the 20-period moving average and the slope oscillator. And I have all the charts to show you these. Intermediate term, where we were turning back and looking more positive with the TTM squeeze after being extreme positive, now we're starting to look more negative. It's actually turning to the darker shade of blue. The PMO studies still have some extreme readings there, and then the bullish percent index for the S&P and the NASDAQ 100. No real changes to the scenario, and even after the Fed meeting, I thought maybe I could change this. The Fed's worried about inflation going up and growth going down, and they don't really know what's going on right now. So there's nothing real definitive in that area. In Friday's session, the dollar was down. Interest rates were up just a tick. We were at 4.38%, where after Thursday, we were at 4.37%. And we haven't changed as far as sentiment. We're still looking more positive at 62. And we're no longer inverted with the 10-year to the 3-month yield curve. We're keeping an eye on that. The 10-year to the 2-year, that one's fine. That's actually steepening after having been inverted for quite a while. Well, this one kind of comes and goes, the 10-year to the 3-month. It spends a couple of days being regular, then it drops back to even, then it goes inverted again. So we just keep an eye on that one. And we're not trending, but we are a little bit positive here. Not any real conviction. The green line is slightly above the red line, but we're below 20. That's why we're not trending right now. And I'm kind of keeping the bias at positive. I could have changed it to negative with the down day, but there was really no conviction. You didn't really see any big up moves or down moves. It was just kind of a day. And as far as the momentum, it's more mixed to positive lately. So we didn't have any economic reports, but I do have some charts to show you here because when I did the video for Friday, these charts weren't updated yet. The weekly jobless claims, this is still looking pretty good where it's coming down. And we usually get these on Thursday. And we did get the reports. It's just the charts weren't updated. So I wanted to go ahead and show them here. So we're back within this range and we're watching this. If this really starts to fall apart, meaning it really goes up because people are filing for initial unemployment, then that's kind of the area that we're watching to see, are we going to go into a recession? Because typically what will happen is employment will start to fall apart about the time we're going into a recession or thereabouts. And then the continuing claims, which we were a little concerned a week ago because that really spiked up. Well, now it's come back down. But we do look at the 4-week moving average here, and they are tending to go up, but we're pretty much range bound, and we've been in this range for quite some time. This also puts it together with the latest unemployment rate, which is unchanged at 4.2%, with the continuing claims in blue and the initial claims in red. Okay, then Treasury bond to corporate BB high. Okay, this is the spread that I show, and I'll be going over this in the weekly video because it's been behaving. And this looks at the spread between risky bonds like junk bonds and more conservative bonds. And when this really starts to go up, that means there are problems. And it was going up when the market was going down. But we're since showing that it's not really a problem right now. And so It's saying that at least at this point, and I use this mainly as a sentiment gauge for the bond market. You can see other times when this really went up big. Well, we were watching this, and I was bringing these charts up in the video, but now it seems to be a little bit more under control. Okay, this also something that I point out all the time. We are below the 200-day moving average. That's the orange one here. We're above the blue line, which is the 50-period moving average, but we're in a downtrend. That's why I say the long-term trend is down. We're not in a bear market, but we are in a downtrend. Then the S&P, I have to move this bar here. Hopefully it's going to let me do that. Market pricing is broadly in line with our forecast. Deutsche Bank, okay, they're coming out and saying, all right, they think that the earnings per share is going to continue to drop, and that's putting some pressure on stocks. Then markets are already back to expensive levels. And again, I do a fairly deep look at the price to earnings ratio and is the market expensive or fairly priced. I do that in the intermarket analysis video over the weekend. This is kind of showing a similar thing here where you have the average PE here between about 17 or so, but then you have the mega caps. They usually, it's okay, at least the market thinks it's okay for them to be expensive, but then the rest of the S&P is actually closer to 15, which is considered to be fairly valued. And then you have stocks in Europe, the Stocks Europe 600, which is kind of their equivalent of the S&P 500. They're not as overpriced right now. And we've been seeing a lot in 2025 where European stocks have been holding up better than US stocks. Okay, then earnings growth in the first quarter fell only modestly and still remain in double digits. We're kind of beyond the main thrust of earnings season now. I also will be going over that in the weekly video. I get information from FactSet there. They think it's going to be coming down here, but I'm not into this blended stuff. It's like you can take all these numbers and mix them up in a different way and try to reach some kind of a conclusion. But the thing is that earnings are still positive, but they're not as positive as the market had been thinking. And so they're lowering the projections going forward, although they're still positive. All right, then the trailing fourth quarter return on equity here, it's at 21.1%. So that's still pretty healthy there. Then the 10-year US Treasury bond yield with the economic surprise index. And this is when an economic report comes out. Is it stronger than expected, weaker than expected, or pretty much as the market expected? And there's a pretty strong correlation here. When we have weaker than expected reports coming out, interest rates tend to come down. And when they're stronger than expected, interest rates tend to go up. And this is just a way to track that. And then wages fall below the Fed funds rate. According to Yahoo Finance here, we're actually seeing wages declining. Not necessarily jobs going away, but according to this chart, the private industry wages and salaries have been coming down. And this is a little bit different chart here. I wanted to include the explanation because you have a number of different ways you can look at the market. Well, I usually go back to the previous week. That's what I look at in the weekly video, and I say, okay, for the week, this is how things looked. And then I go back to the beginning of 2025. I use that as a basic benchmark just to let us know where we're at. Well, another way you can look at things is called a rolling return. If you go back to the low that was set April 8th, and then how have we done since then? Because the problem with this way of looking at things is you don't know what's happening at that time. You only look back and through the perspective of, oh, we've really gone up since then. But you don't know that that's what's going to happen. Well, the S&P is up 14% from the low that it set back at the beginning of April. And of course, this is since 2020. I mean, we were bouncing up out of the COVID plunge after that. And then what happens going forward here? It says the S&P has gained 14% from the low in early April. 1 month rolling returns. So that's the variable there. You roll it to the low and then calculate going forward. At these levels of greater than 14% is often carried with it forward 12-month returns of 25% on average, and it's up 95% of the time since 1978. And there have been 56 times that has happened. So that's fairly positive. We'll see. There's a lot of variables that this chart doesn't necessarily account for with like the trade talks and the tariffs and all the changes that are taking place right now. But we can still use this as some kind of a base to build knowledge from. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. All right, here's the chart. We never did get back above this 5,700 level. We tried, and incidentally, when we topped out on Thursday, we were hitting the 200-day moving average with the SPY. That's the ETF that goes along with the S&P 500. We hit that. We're still further away from the 200-day moving average with the S&P itself. And I didn't mention that in Friday's video, so I wanted to bring that up here. But that was where we hit resistance, right at about 50, it was about 57.60 or so in Thursday's session. But then we look at Friday's session, not an awful lot of conviction here. A little bit of gyration. We had a positive open, but then we went down. We hit support at 56.50 and then just chopped around. We went a little bit positive, a little bit negative, a little bit positive, a little bit negative, and ended up closing down below the daily pivot. All right, and then pretty quiet as things closed down for the weekend. And as I said, I'll be watching this Sunday evening to see, okay, what kind of news is coming out of these trade talks. We're still looking better here when we look at the intraday chart of growth of value. The blue line is still above the red line. And we're still looking pretty good here. Not much of a change in Friday's session when we look at the S&P growth of value intraday chart. And then here's the end of days here, where growth was down more than value for the large caps, down more for the mid caps, and up less for the small caps. So we are still seeing a general uptrend here when we look at small cap growth or value, the end of day chart. Tick down just a little bit of a tick down, but still above the moving averages with the mid cap growth to value, and just kind of chopping around a little bit lately here with the S&P growth to value ratio. But we are in a downtrend here. We need to stay above these lines for longer to have this blue line turn back up and see a golden cross with this ratio. And still pretty much hanging out in the middle part of the rainbow with this growth to value ratio. Still underneath the 200-day moving average with the discretionary to staples ratio, and in a recent downtrend there. We need to see more improvement with this. As far as our trend, short term, we're not trending. We're below the blue line of 20, and that's going down, and we're below the moving average. We are positive because the green line is just barely above the red line. And also no trend in the intermediate term. We're below 20, below the moving average, positive because the green line is above the red line. Really dropping off with volume here, and you can see for the most part, we've been way below average since the big downward move, and then Friday was even more below average. Okay, sentiment, we are dropping a little bit here. We're under 22 with the VIX. That's the good news. The bad news is we're still above 20. And we're seeing volatility dropping off here with the VIX of the VIX as well. The momentum of the VIX continues to be down. We ticked up with this one fear gauge just a little bit, and we actually went down with the other fear gauge. So not an awful lot of conviction here. We actually declined. Now, this is a little bit surprising. If you try to put logic into the equity put call ratio, you're going to be frustrated a lot. Because ahead of the trade talks, you want to make sure you're hedged. All right. And that's what I do. And that's what I teach in the program I have. And so you would think there would be more puts being bought here ahead of the weekend. But no, the daily chart actually declined, and we're going up with the 5-day chart, and we're just barely ticking up with the 10-day chart. And we are showing general improvement here when we look at high beta to low beta ratio. More positive environments, this ratio goes up. Coming up from getting a really extreme low reading with volatility risk premium. So we'll be watching that to see if this continues to go up. So that folks that own stocks, when we get a higher reading, that means they're being compensated more for the risk of owning that particular asset. All right, the advanced decline line still positive here, above advancing moving averages based on price and volume. Still above zero with the advanced decline ratio, short and intermediate term. A little bit below the red line here after becoming extreme with the advancers decliners oscillator. And still looking better here. We're seeing the new highs improving, more green than red for the most part. So the 5-day chart is going up and the 10-day chart is slowly going up. And the accumulation distribution, we are coming down, but we are above an advancing moving average. And there's other ways that I use to interpret this that go a little bit beyond if we're above or below the red line. If you're interested in that, please check out some of the other videos that I do. And we are declining here with the chicken money flow. This is actually negative. So our smart money indicator is negative. And ever since last Friday, we've been declining with the chicken oscillator. It's picking up something it doesn't like. And this is also a smart money indicator, and it's been declining. So really, our smart money indicators are showing some weakness now. But the vortex actually showed some strength. The green line's going up and the red line's going down. One thing to be aware of, when the red line gets down, either one of these, if either one of these lines gets down to this red line, that's where we start to pay more attention. That sometimes can signal that we might be going in the opposite direction. We're still positive with the advanced decline line studies. We're above moving averages with all the indexes that we follow. Coming down a little bit, declining slightly with the stocks inside the S&P above their 20-period moving average. A week ago on Friday, it had become extreme. That was a concern. We've been working off that extreme reading since then. And we are still above 50. We're seeing some general improvement with the intermediate term trend, but we're improving, but still below 50 with the 100-period moving average study. And we actually declined a little bit with the 200-period moving average study, and we're still below 50. So the short term is looking rather robust. It just took kind of a day off on Friday, but we see much more of an upward move. We're going to become overbought, and we have overhead resistance. The intermediate term is showing slight improvement. We're trying to see if the longer term will show more improvement there. And here's the daily chart where we're below the 200-day moving average, but this is, if you look at the SPY chart, that's the high that we hit on Thursday, and we weren't able to go above that. We still have a ways to go to get up to the 200-day moving average here on the S&P index. That's the negative part, and this is producing overhead resistance. The positive part is we're above the blue line, which is the 50-period moving average. On the bottom, we're way below average there. Still holding on in the short term, looking pretty positive here at 73, showing some improvement, going above 50 here with the 50-period moving average study and just barely above 50 with the 200. And then we have our usual suspect charts here. The StochRSI still showing that the short-term momentum is positive, as is the Williams percent R. But the CCI 14, it's not quite as robust, nor is the CCI 20. We're still looking extreme positive in the short-term stochastic. It's been coming down lately. Still extreme with the intermediate short term and still showing some strength and being extreme with the long short-term stochastic. Still above zero with the force index. That's a positive there. The condition of the short-term trend, still looking okay. The lines are going up. If we stay above these lines will continue to go up and just show that the short-term trend is more positive. And we're above the 20-period simple and exponential moving averages. So that's why we're positive in the short term. We're just at the lower end of the +2 channel with our standard deviations chart. So that's looking good, and the midpoint continues to go up. Now we switch over to the intermediate term. Balance of power continues to go up. That's actually showing some improvement there. And the bow tie, the fluorescent green, we're still above this short-term moving average here. And that's why we're seeing these lines start to shift and look more positive. And we're positive with the go, no go. We have the light blue. So that's called a go for right now, according to this chart. And we're still above the midpoint with our highest high value. We're up near the blue reading here. So this chart continues to improve as well. We're positive with the Landry light. That's still green. And it's really hard to see here, but you can barely see new histogram bars. But this is trying to turn over positive. It had been negative because it has a red background. It's signaling this is yellow. That's more neutral for right now. So where it had been more red. So we're turning from negative possibly back over to positive here, but it hasn't actually switched that far yet. There's the TTM squeeze where when it turns to the darker shade of blue, that's turning more negative, and we're way above this black line. That's showing that it's extreme, and this is the extreme reading that we've been seeing now on this chart. And we are looking better with the ease of movement. We're above zero and going up. That's positive. The Arun is above zero with the oscillator and going up. That's positive. We're coming down a little bit. We're no longer extreme with the S&P McClellan oscillator, but we're still above zero. So this still is hanging on to being positive. And when that's positive, the summation index based on price goes up, and we're also going up with the summation index based on volume, and still above zero with the NYSE McClellan oscillator. So the summation index based on price and volume continue to go up. But we're negative here. The Switzerland Trading Oscillator declining based on price and volume, but both of these are still above zero. And momentum is still positive with the PMO. We're also positive based on price and volume. No longer extreme with the PMOs that are rising. That's starting to kind of flatten out right now. The buy signals are rolling over a little bit, but they're still extreme positive, and we're showing some improvement gradually here with the PMOs that are above zero. And we're still neutral, though, with the Elder's Impulse system. We're positive with the parabolic SAR, and we're still extreme with the slope oscillator. This is short term, and we get a little concerned when it gets a really high reading like this. But the MACD, this is more short to intermediate term. This is still positive here. So we look at all of our oscillators. We're extreme with the slope oscillator. The other short term TSI oscillator, that's still looking positive and crossing above the midpoint. Our three intermediate term oscillators are positive, and our two long-term oscillators are still positive there. We're still positive here with the Copic curve. And just to give it a little bit more perspective, we're getting a pretty high reading here with the Copic curve. Doesn't mean we're going to necessarily turn from here, but when it gets to a high reading like this, this is when we watch it a little more closely. Still up in this upper end of the yellow area here with the Sean trend meter after it had been improving. We're starting to flatten out now. And we're still above 50 with the money flow. We're declining, but above 50 with the ultimate oscillator, above the moving average with on-balance volume, above 50 with the RSI 14 and the RSI 9, and above the 50-period simple and exponential moving averages. So that's why we're positive in the intermediate term. This is where we seem to be bumping into some resistance. This is the 100-day exponential moving average, and we can't seem to be able to get above that and stay above that. Here's all the different moving averages. Above the 20, but still, and the 50, but still below the 100. And we're still far away from the 20-period moving average as measured by the boom indicator. And that's when price has a tendency, when it gets too far away, it's like a magnet and it's pulled back towards the moving average. And in this case, that would mean a decline. We're still looking okay with the 50, and we're trying to cross above zero here with the 200 moving average steady. Coming back up a little bit and looking extreme with the bullish percent index for the S&P. We're also above 50 and going up with the NYSE bullish percent index, and just kind of flat but still extreme with the NASDAQ 100 bullish percent index. Then looking at this level here, this is the 61.8% retracement. It's a Fibonacci retracement going from the low that was set in April 2024 to the all-time high set in February 2025. We've been able to recoup a lot of these levels here, but we've not been able to get back above this 61.8 level here. This seems to be acting as overhead resistance. And now we've been coming back up in the Ichimoku cloud, where this is red, that's more negative. And we're looking positive though. The green line, it's mixed up in price here. That has really been improving, and the blue line's above the red line. So that's looking better. But the cloud itself may end up acting as overhead resistance more in the short term. If we can break through above that, that would be more positive. If we break down from this, that means that this resistance level may be more impactful. And this is still positive, though, longer term. We closed the week above this P, the pivot point here. The pivot point's at 55.75. We closed at 56.60, basically. And so that we're holding on to longer term support. As far as our trend, looking at it different ways, the Heiken Ashi continues to be positive, as is the Kagi chart, the Renko chart, and the three-line break chart. Longer term, still showing gradual improvement here with the 150 and 200 period moving average study. And we're still positive in the short term with all the indexes, negative in the intermediate term. We continue to be negative in the long term with the mid caps and small caps. And we're back to what we were saying before. The dollar was down a bit. So on all the different time frames, bonds, commodities, and the dollar are negative, where stocks have been showing some improvement. And energy, which has just been getting hit hard lately, it was the strongest performing area in Friday's session, where we had healthcare, another defensive area. It was down the most, and staples declined. That's more defensive. But then we had communication and tech. They ended up being down as well. These are growth areas that didn't have a great day. Discretionary did okay, but we need to see more follow through with that. An awful lot of green or blue to start off the day. Most of these were triggered not long after the market opened, where we had the NASDAQ above 17.8, 17.9. It got above 18,000, but then it went below 17.9. Oil is back above 70. That's treated as positive here, but for us, it might be more negative. And then we had energy having a BPI cross above 50. So we're going to be keeping an eye on that to see if energy is making a comeback. The dollar did get back above 100, but then ended up dropping down below it. And we had a BPI cross above 70, the chart that I just showed a moment ago. And the financials had a BPI cross above 80. So that's showing some strength there. And here's the market carpet. Not really much to show. You saw weakness in healthcare, awful lot of red, more weakness in communication. Some green here in industrials, energy, that was the best performing area. So that's an awful lot of green there. And not really much here in tech or discretionary. Amazon was up and Tesla was up. So that helped things a little bit there. All right. We're still trying to figure out because a week ago, the 50-day moving average for the Dow was acting as resistance. Now we seem to be a little bit above that. So that is somewhat positive there. But we're neutral with the Elder's Impulse system for the diamonds. We're above the 50-period moving average with the NASDAQ, still below the 200-day moving average. Neutral with the Elder's Impulse system for the NASDAQ, and also having a difficult time breaking above the 200-day moving average with the NASDAQ 100. We've spent many days trying to get above this, 3 just out of the 5 of this past week. We have not been able to get above that level. 1, 2, 3, 4, 5. Okay, out of the last 5 days, we tried 2 times. This was Friday a week ago. Okay, we're in neutral with the Qs when looking at the Elder's Impulse system, but the momentum for the NASDAQ 100 is positive. And we broke above the 50-period moving average with the small caps, but they've got a lot of damage to repair. Looking better here with the other small cap index, the Russell 2000. We're above 50 with the RSI. The momentum is positive, and we're back above the 50-day moving average. But we're neutral after being positive with the small caps. Mid caps also above their 50-day moving average, but still neutral with the Elder's Impulse system. And we look at the Wilshire 5000, it's kind of a similar story here. Above the 50-day moving average, but still below the 200. Same here. Total U.S. stock ETF above the 50, below the 200. Financial sector looking better, was virtually unchanged, but above its 50-day moving average. The FANG index, after it generated a death cross, that's when we saw a little bit of a bounce here, but awful lot of sideways action recently. Apple in a downtrend, it was up 0.5%. Amazon also in a downtrend, it was up 0.5%. Microsoft above both of the moving averages. The longer it can stay here, the more the 50 might come up and give us the golden cross, but it's going to take a while for that to happen. Google is also in a downtrend, down about 1%, falling under its 50-day moving average. Meta just starting to see a death cross here. It was down almost 1%. Nvidia in a downtrend, but above its 50, below its 200-day moving average. Tesla breaking out a little bit above its 200-day moving average here. It was one of the stronger areas, up 4.72%. Netflix down a little more than a third of a percent, just coming off of setting recent all-time highs. Then looking at the correlation between US and world stocks, pretty strong in the short term, showing a little bit of strengthening here in the long-term correlation. Keeping an eye on this, where we look at the SPY to Staples ratio, for the most part, this has been really deteriorating here, but lately it's been improving. So we don't want to draw all of our conclusions from this. This is just something we're keeping an eye on because that's what we saw at the end of 2021. Now it was cleaner here. We started coming down and really never looked back, where we've been deteriorating here and now trying to make a comeback. So we don't know if it's going to play out the same way as it did in late 2021 in now in 2025, but we just want to keep an eye on this. Oil is going back up into the low 60s now, and the dollar back above 100, but it did decline in Friday's session and in a downtrend. And looking at the latest read of inflation by Truflation coming in at 1.62%. And we were up a little bit here with the yield. We were down just a little bit here based on price. And we're not inverted right now with the 10-year to the 3-month, but it's right on the border. Still looking okay here with the Qs to S&P, a little bit better with discretionary to the S&P. We want this above the moving average and the moving average to go up. A little bit of a decline, but still above an advancing moving average when we compare large cap growth to large cap value. So we're above the moving average with the large caps, mid caps, and small caps. That's more positive. So what's our outlook then for Monday? We're still positive in the short and intermediate term, or we're negative in the long term. We're going to get the Treasury budget in Monday's session. That's pretty much it. There's going to be some big reports, but it's later in the week. And all eyes are on the trade talks right now. That's really what's happening. And let's see. CPI is going to be coming out on Tuesday. We're going to get, this is strange. Usually we get PPI and retail sales on different days. They're coming out on the same day. And we get our whole list here on Thursday, plus a nice little speech from Fed Chair Powell. And then consumer sentiment will be coming out on Friday. Here's also a look at the upcoming calendar for the week, economically speaking. And now we look at May 12th, not much of an edge here. Neutral to positive with the Dow and S&P, neutral to negative for the NASDAQ. We are coming into options expiration week. And it's almost a coin toss. We're up 47% of the time. We're down 53. So a little bit of an edge to things being more negative. The week after is fairly positive, but we have to make it through the upcoming week first. And we do see a little bit of negative seasonality during post-election years. And we've been kind of coming down a little bit before we see some more positive seasonality. And here are the pivot points for Monday's session with R2, R1, the pivot point S1, S2. And I do update this on the YouTube community tab every day. All right, now okay, this is out of order here, but we're switching over more to negative with our 3 smart money indicators. Accumulation distribution, it's still above the moving average, but it's declining. And I use a boom indicator that I didn't show in this chart that I had earlier. It's actually dropping more negative. So that's more short term. Where longer term, it's still above its moving average. But we're negative with the Chaikin money flow and the Chaikin oscillator. And we've been negative for a week now with the Chaikin oscillator. We're also more concerned about the longer term growth to value ratio as well as the discretionary to staples ratio. And our moving average studies, we're looking pretty good with the 20-period moving average. We're improving with the 50, but we still have the 100 and 200 that are below 50. And our long-term special K chart, which I'll show in the deep dive video over the weekend, that is still negative. Then the positive side, the S&P and NYSE McClellan oscillators and summation indexes are positive. The bullish percent indexes for the S&P, NASDAQ, and NYSE are positive there. Parabolic SAR, the Swindlen Trading Oscillator, that's actually, I should have changed this over to the negative side. Sorry about that. And we have been declining with the 20-period moving average study. It's positive, but we're really keeping an eye on that because it's the short term that's been seeing a lot of the strength lately. And it's probably going to be the short term that will break down if we start to see more of a decline. We're still positive, though, with the S&P McClellan oscillators. We're positive with momentum there. Ease of movement, money flow, and ultimate oscillator are all still positive. The vortex is positive, the financial sector is positive, and the momentum for the NASDAQ 100 is positive. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. So our conclusion, haven't changed this now for quite some time. We're still positive in the short and intermediate term, negative in the long term. We're positive in the short term, but waiting for trade talk results. And it's going to be results that the market is open to receiving for it to be positive. There could be a real disappointment if things don't turn out. That's why I'll be watching the futures. And that we are showing some weakness in the short term. And we're not trending right now. In the intermediate term, we're positive, also not trending there, though. And we still continue to be negative in the long term because we are now in a downtrend and below the 200-day simple moving average. Thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.